This is the first in a three-part series of interviews with RateSetter, the peer-to-peer lender. In this interview, you're going to find out what peer-to-peer lending is, what products RateSetter offers, and also what kind of returns to expect from those products. So here we go. Well, thank you very much for joining me, Mario Lupori. You're the Chief Product Officer for RateSetter, the very large and successful UK peer-to-peer lending company. And I understand that congratulations are in order because you've just reached a milestone at RateSetter. Is that right?
Yes, thank you. We have reached a milestone. We have returned £100 million of interest to our investors, which is just a phenomenal figure for us to have breached. But I care to add that is just the beginning. So we've been going for 7 years, and the truth is that we're still at the beginning of our journey. We look at some of our competitors that have been going for 350 years. So there's a long way to go yet. £100 million is not small, but on the other hand, you're going to see a lot more, and the numbers will keep adding up.
Now, RateSetter is a kind of twist on capitalism, which is possible because of technology, because it used to be that banks would be the people that would intermediate between people with capital, which they then pass on to those who wanted to borrow capital through the capital markets.
Yes.
But what you've done is kind of short circuit that, and you allow people to lend to each other and borrow directly. So is that a fair description of what you do?
That's absolutely a fair description. So RateSetter itself is just a platform. We connect people. Our purpose really is to, we're providing access to a new asset class, and that is the asset class of loans. I would perhaps just clarify the obvious thing that RateSetter hasn't invented loans. Loans have existed since the beginning of time. And we didn't invent investing in loans either. But what we're doing is in essence democratizing access. We're allowing ordinary people and the everyday investor to access this very healthy asset class. So to underline that point, banks and institutions have been investing in loans for a very long period of time, and what they provide in return to the people who deposit money with them is a safe product with all the accoutrements that come with it. What we are allowing customers to get is to share, or rather, by directly accessing that loan, that asset class, they get much more of their reward. So it is shrinking the size of the bank in this exchange, because we are merely the platform in the exchange, and it's allowing better returns for the investor and also very competitive rates for the borrowers. So both customers win.
Okay, so obviously people are interested in the rates of return, which vary all the time, obviously. But maybe you could give us an idea of what kind of returns you get with RateSetter at the moment for your different types of product, and maybe just briefly touch on the types of product you offer.
Yes. So the rates of return are different according to the product that one chooses to invest in at RateSetter, and they also vary by day because we've got a market rate. So the question you asked there particularly is what on average are those rates? Now they've been averaging between 3 and 6%, and that is according to the term that one wishes to commit their money for. And those would be there for the products. We have a product with a no access fee, and that means that one can invest into loans immediately, very easily. It's a simple product, and there's no charge for seeking to withdraw that money. Now, to be clear, when one seeks to withdraw or terminate their investment at RateSetter, that what they're doing is, or rather what RateSetter has to do in the background is transfer that loan onto another lender. So there has to be another lender that is willing to take on that investment, because of course the money isn't with us. Like, or rather, contrary to how it would work with a bank, where you deposit your money in your current account and a good part of that money is in the current account, and if it isn't, it's protected by the government, the FSCS. For us, actually, that money is with the borrower. That's where the investment is. So when someone requests for their money to be returned, really that is another lender that has to step in and take on that investment until the borrower, according to the terms of their investment, repays. When all that happens, there's a cost to withdraw the money, for us to manage it, and also because the rates may have changed during the course of that investment. But we have a product where RateSetter takes all that risk on, or that cost on. So there is no access fee whatsoever in the rolling market. Then at the other end, we have the 5-year market. The 5-year market is generally invested for or by people who are seeking a higher return, and they accept that they won't need to access their money with perhaps the same frequency as someone in the rolling market. And that has an access fee of 1.5%.
Okay, so you pay a penalty if you take your money out of the 5-year early. And the rolling is a little bit like a kind of instant access savings account, because
yes,
no rate of return, but you can take your money out without a penalty.
Absolutely. I would probably steer away from calling it a savings account, an instant access savings account. In many ways it works that way, but I care to clarify that it's not savings, it's not FSCS protected. And in the case of the 5-year market, it's not so much about terminating early, in essence, because the borrower will return money on a monthly basis, and one isn't committing necessarily to 5 years. But really, so the simpler way of thinking about it is that they're earning a higher return, and they will be, as long as they're investing for a period longer than, I would say, about a year, then it would be worthwhile for them to invest in the 5-year rather than the rolling market. That is seen in the difference between what one can earn. So one can earn in the region of 5% in the 5-year market, and they might earn in the region of 3% in the rolling market. The fee when one requests to withdraw from the 5-year market is only 1.5%. So you can see there that quite quickly the rate of return would recover any fee.
Now, for the 5-year product, does the rate of interest vary according to market forces, or is it locked in when you buy the product?
It's the rate that you get is for that investment is the rate that you were expecting at the start. So yes, for all intents and purposes, you could say it's locked in. However, it's not for over the whole term. You might earn a different amount, because how the product works is that when a borrower repays capital and indeed interest on a monthly basis, that money is then reinvested. So on the original capital, you would earn what you expected to earn. However, what is then repaid and reinvested would earn whatever the rate was when that money was reinvested. Does that make sense?
Yeah, so the rate does actually change, but perhaps slowly over time. Is that right?
Yes, you would expect that over the course of 5 years, your average, the average balance over those 5 years is it would be half. It would be on 2.5 years that you would be earning what you expected at the time of putting money in. And then on the other, for the other 2.5 years, you'd be earning a different rate, which could be higher, or indeed could be lower than the rate when you first invested.
So there is a little bit of duration risk, like a little bit like it's like a halfway between a floating and a fixed rate bond. Okay.
Certainly. Now there is that is different with slightly different with a rolling market, but of course, as I said, money get reinvested and automatically reinvested at the market rate.
I hope you found that video useful and informative. Please support us by clicking on the Patreon link, and if you don't want to miss any of our videos, then subscribe to our channel on YouTube.